Dollar General is quickly turning into a name that analysts are turning against, and as a result, the share price is now down approximately 50% in the last 6 months. But the question is, now that the investment community largely has turned against this name and they're pushing down the stock price, why is it that some value investors are seeing opportunity or a potential opportunity in this security? That's what I want to talk about in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, as you guys are well aware of the story, Dollar General's share price got hit 2 major times, and both of them largely are risks of the consumer. And so obviously, the first time this happened, there's a lot of concern about high levels of growth. And then of course, when the second time the share price dipped now close to the low $100 per share level, it's because people are really worried that even Dollar General's consumer is going to be potentially pinched as the economy continues to slow down. And so there's a lot of people in the investment community that are moving away from this security as they see more risk than reward. But does this create a potential opportunity for us? Well, let's first start with what the analyst community is saying. At least one major analyst that does seem to have influenced the share price. So you can see Matthew Boss, the JP Morgan analyst, by the way, that's an awesome name, downgraded the security to underweight from neutral and cut his price target to $116 per share from 132. Now just keep in mind that's a 12-month price target, so he expects the security to trade at $116 12 months from now. That doesn't necessarily mean that that's what he believes that the ultimate valuation for the security is. So keep that in mind. There's a difference between what we're doing in terms of valuing the company's intrinsic value versus what the analyst community is doing. So just FYI guys. Now, the lower end consumer, which is the primary consumer at Dollar General, is already facing financial stressors. Inflation has remained stubbornly high, and recall guys that the Fed just came out and said that we're probably going to see rates higher for longer. So the Dollar General consumer is probably going to remain facing these stressors for a lot longer than what we originally anticipated. And of course, those rates are going to stay high because inflation has remained stubbornly high. Interest rates have steadily risen, and government assistance has diminished. And this is the other part that people are now starting to worry about. And the analyst goes on to say that these issues won't be going away soon and will likely be intensified. And this is that whole government assistance part, as student loan payments resume next month. And of course, the other issue that, energy prices are increasing. And so, it looks like Dollar General's core low-end consumer, which is household incomes under $35,000 a year, is already at a stressing point, and they're already acting recessionary today. And I would say that a lot of people are feeling the pinch right now. I don't think you even have to be on that lower end of the consumer. I think a lot of people are tightening their belts. You're definitely seeing that in many areas of the economy. And in the last call, Dollar General's CEO said that our core customers continue to tell us that they feel financially constrained. And recall guys, that was the call where Dollar General actually cut its forecast, which is what caused the share price to continue to spiral downwards. And now we're almost at 50% of a decline over the last 6 months. So the company lost half its value over just the last 6 months, which is kind of nuts. And we're not even at a recession yet. So what happens if the economic environment gets even worse? Well, I think a couple of things. One thing is, I think the share price continues to go down. But the second thing is, this is a strong business that continues to remain profitable, and they're even still forecasting profitability in this weakened environment. And so what does this company look like, and what should it be valued at when, the clouds go away? Well, first, let's just dive into exactly what they forecasted, and then let's move towards what the story and the thesis is here. So this is from their press release. So you can actually just grab this from their website, but you can see that this is the guidance that they provided. So they do expect an incremental operating profit headwind of up to $170 million in the second half of 2023. However, notice that they are still forecasting growth, albeit slower than what they were previously forecasting at 1.3 to 3.3 versus 3.5 to 5. And they do expect same-store sales growth in the range of a small decline to approximately 1%. Okay, fine. But here's the kicker. The company is still profitable. They expect diluted earnings per share of around $7 to $8. So call it $8 in the middle, maybe $7.75, whatever it is. But that reflects that the company is not expensive at all because the current share price is approximately 15 times earnings. Now, here's the thing. And, just FYI, they still managed to open 990 new stores. Now, here's the thing. You have a company that's continuing to aggressively open stores. They have a ton of stores already, but they continue to embark on this strategy of continuing to open stores in an environment where it's priced at 15 times earnings, so effectively not a ton of growth. Really, you can achieve the growth expectations from just ongoing same-store sales growth over time, and maybe just like a 1 or 2% footprint growth. So it's not a super high hurdle to overpass. And so the question is, what exactly is Dollar Store? I would argue that Dollar Store is a company that not even Walmart can compete against. And I know that you guys might think that that's a bold statement, but take a look at this video that I was watching recently on YouTube. It came out a couple of weeks ago and it already got 2 million views. When I do my scuttlebutt for companies that I'm potentially looking to invest in, I look at everything. I just do a Google search of the company's name and I look for anything that I can find. I was lucky that somebody just made a video 2 weeks ago about the rise of Dollar General, and it really explains their strategy. And when you watch the video, you're just like, oh yeah, this makes a lot of sense. I've seen this. I've gone to dollar stores. I understand the strategy. And so what this means to me is that, does the company have staying power and does the company have a moat? And the answer to both of those questions is yes. Okay, so if the company has staying power and the company has a moat, then what happens when the consumer environment turns favorable, where we pass this recessionary situation? And so that's the way I'm thinking about this 5-10 years down the road. This could potentially be a stock that you would keep as a cornerstone in your portfolio. And so let's take a look at the valuation. Let's see what this thing looks like. So this is the model that the Patreons get access to. And so you can see that in fiscal year 2023, this year, they're expecting to come in at around $7.60 per share. But the question is, what happens if in 2024, the recession that everyone's predicting doesn't actually happen and the company just grows its store count by 2% and they just grow same-store sales by 2%? Well, you'd have at least like on average a 4% revenue growth rate. I know that it's not perfect. It's just the way that I forecast it. And so you guys, please feel free to forecast this any way you want. But I also think the same-store sales growth of 2% is probably low for 2024, especially considering that we're in an inflationary environment, but it's potentially offset by a weaker consumer. So yeah, you can have a little bit of a headwind there, but I think the average rate is probably around 3%. That being said, if you increase revenues by 4% and you have operating profit margins of 8%, which is actually lower than what they've experienced in the previous 3 years, then you're looking at an earnings per share of around $10 per share. Well, that means that the company's trading currently at approximately 11.2 times earnings. Right now, based on 2023's earnings, that $108 per share means that the company's trading at approximately 14 times earnings. And so you're looking at a company with a very strong moat and the potential to increase earnings with a very low multiple. And so it's really coming into that area where it's starting to look cheap, depending on how you look at the overall economy. But if 2025 and 2026 actually roll out the way that it's modeled here, you get a 3% store count growth and a 3% same store sales growth. Now, FYI, I'm keeping the store count growth figures low, even though they've achieved higher rates, because I do believe that growth acts like an anchor. This is something that Warren Buffett has said a lot, and I absolutely believe in it, that the more store count you get, like the higher the number of store count gets, the harder it is to open up new stores. You already have 20,000 stores in America. How high can you get this? I'm sure you can, and they will make an argument that they can get there. But remember, there's competition everywhere in the dollar store space. So I think 3% is reasonable. So if by 2025 you are earning $11 per share, this is potentially $165, $170 per share stock that's currently trading at $108 per share if it revalues using 15 times earnings. So that's what I mean, what the potential opportunity is. And this is one of those businesses that I do believe has staying power and competitiveness. And so if it's just, short-term headwinds that are impacting the business, then this could potentially really be a value opportunity for long-term investors. However, let's go into the valuation to see exactly how comfortable, at least I am, with the current share price. So the only thing that I would say about the current share price is, notice that I'm valuing them using a 15 times earnings multiple. You guys can use whatever multiple you want. There's a lot of people who will use 12.5 times for dollar stores. I completely get it, because there's a lot of competition and it's retail. Retail is just naturally tough. So I understand that. So you'll probably just use a lower multiple. And so I'm valuing them at around $185 per share. Then I'm removing the debt because I'm valuing the equity. And so I'm valuing them at approximately $155 per share, which means that I think, at least in my opinion, that the company's trading at around 70% of its intrinsic value. That is very cheap. You're now entering the buy territory for this security, but I am very greedy in this environment. And so I would really love for this thing to come down a little bit lower. Now, there are other ways to enter into this potential opportunity. I always talk about stock options in this particular scenario, especially cash secured puts. So let me look at some cash secured put opportunities with you on this call. But first, just a quick plug. If you want access to that Dollar General model and all of the models that the Patreons get access to, you can join us at that lower tier. And just FYI, guys, there's always 100% money back guarantee because I want you to receive value from the Patreon subscription. And if you're not receiving value, then I don't want to take your money. So there's absolutely zero risk to you. And I really believe that I'm in the business of creating long-term partnerships. There are some Patreons that are a part of this group that have been here for years and they're not going, it doesn't seem like they're going anywhere because they really see value. They're on the calls every month, etc. So I would say that there's a very wonderful community that's starting to build here and I absolutely love it. Now, with respect to the Dollar General cash secured puts, I looked at the January 17, 2025s. Now, you guys recall, I like looking at really long dated options because it brings down my downside considerably. So the $85 cash secured puts will take me into that, 70-ish dollar per share area. And of course, that $70-ish per share area relative to the $150 per share-ish valuation gives you approximately 50% of your intrinsic value. So that's why I chose this number. But now let's put it into the analyzer. And recall, guys, that you guys have free access to the options analyzer tool, which is in the description of this video. And so I actually queued this up for you so you can see it, download it, change the inputs however you wish, change the exercise dates, change the money market rates, like do whatever you want. And it's completely free for you guys. So it's just one way of helping you guys out. Now, just FYI, the money market rate can decline. So just keep that in mind. I put 5% today. In a previous video, I put 4%, but I think because it sounds like the Fed is going to keep rates higher for longer, I'm comfortable with 5%. So the strike price is 85. The exercise date is 2025. The premium is $7.20. You will earn $5.14 for the net amount of cash that you leave in the account at 5%. So the net amount is the 85 minus the 720 over 482 days. So, 85 minus 720 times 5% divided by 365 times 482 is what gets you that $5.14 per share. And so you have to add that to your return. So these two combined give you $12.34. And that is part of the return that you generate, or that is the return you generate if you are not assigned on the cash secured put. So in other words, if the shares do not drop under $85 per share, recall that they're currently at $108 per share. So if they do not drop below if they do not drop below $85 per share, what you earn is the cash interest for the cash set aside plus the premium that you generated as well. And so you generated approximately 16% over the 482 days. But if you annualize that, that's 12%. So that is not bad for a company like this. And what does that really reflect? Well, your net purchase price is $72 or $73 per share. So if you are assigned on the cash secured put, you have to take it at $85 per share, less your premium, less the cash earned. Your net purchase price is $72.66 per share. The valuation is $153. So you have purchased this company at a net purchase price of under 50% of its intrinsic value. And if the EPS run rate is $11 per share in 2025 and beyond, you have an annual equity yield of 15.23%. So this is not a bad opportunity here. Now, what I want to do is because this looks pretty good, this is a little bit low. I wouldn't mind this just being at 50%. I want to see what the $90 looks like. And when I was looking at the $90, I got really close. But what I decided to do is I decided to create a scenario. And this is why I say download this and just create scenarios that work for you. I would love if I can get the $90 for $11. And I think if the share price goes under $100 per share, I can probably do that. And so what that would mean is that my net purchase price would be, similar to what we saw before, but because I get a higher premium, you can see that my annualized yield is much higher. So, if I'm setting aside the cash, I want to make sure that I get paid for that. And so now instead of making 12%, I'm making 15.5%. So that's really good. And if I get exercised, recall, guys, that, the $11 on the net purchase price is 73, I'm making 15%. And so I'm closely watching Dollar General. If this thing continues to come down, I'll pick it up first with cash secured puts. If it continues to come down further, if the share price actually goes under $90 per share, or even closer to that, $70, $80 per share, which I don't think will happen, but you never know what could happen in long drawn out recessions, I will absolutely look to pick just the shares up themselves. So right now you can see that it's a little bit too expensive to just buy the shares flat out. I mean, there's a lot of people who are very comfortable with buying the shares at this price, and all the power to you. I don't think you're making a mistake. There's a lot of super investors that are doing that as well. But just for me personally, just for me to feel comfortable, I'm going to use the cash secured puts until the share price comes down a little bit more. So keep watching this. You guys let me know what you think in the comments below. I respond to absolutely everyone. Now, if you missed my video on how I'm buying into the gap opportunity, or at least how I bought into the gap opportunity, I provide you with some scenarios that I go through, and you can actually get access to that video right here.